So, options. When you hear that word, what comes to mind? For a lot of folks, it's probably something like reckless bets, people blowing up their trading accounts. But for the pros, it's a completely different world. They speak a different language. They see options not as a gamble, but as this incredibly precise toolkit. So what do they know that the rest of us don't? Well, let's dive in and find out.
And this quote right here, it just hits the nail on the head. Forget everything you think you know about options being lottery tickets. We're going to look at them through a professional's eyes. Not as tools for gambling, but as these sophisticated instruments for actually designing and managing risk.
Okay, so here's our game plan. First, we're going to shift our mindset away from that casino mentality. Then we'll get into the unique mechanics of options, learn the language the pros use to talk about risk, see how they actually build custom outcomes, and finally, we'll uncover the single most important question they ask before they ever place a trade. All right, so this first part is all about a mental shift. See, a professional doesn't just ask, hey, is this thing going up or down? No, they use options to control the how and the when of a market move. They take uncertainty, something that terrifies most people, and they turn it into just another variable they can manage. Think about it this way. Let's say your big idea is, this stock will go up. That's a pretty fragile idea, right? It's kind of like a house of cards. One bad day, one gust of wind, and the whole thing comes crashing down. A professional uses options to build a fortress around that same idea, making it tough enough to survive the chaos that you know is coming in the market. So how exactly do they build this fortress? Well, they do it by fundamentally breaking the straight line. And this is what makes options so unique. Unlike pretty much every other investment, they don't have that simple one-to-one relationship between profit and loss. And this slide just lays it out perfectly. With something like a futures contract, it's totally linear. For every dollar the market moves in your favor, you make $1. For every dollar it moves against you, you lose $1. It's a straight, symmetrical line. But an option introduces choice. You have the right to do something, but not the obligation. And that one little word creates an asymmetric or curved payoff. It means you can cap your losses while leaving your potential gains wide open. Now, that beautiful, curved advantage has a name: convexity. This is the secret sauce. When you buy an option, you aren't just buying the right to a stock at a certain price. What you are really buying is a mathematical edge, the ability to win faster when you're right and lose slower when you're wrong. That is the real product. So if you want to really wield the power of convexity, you've got to learn to speak the language. And that language is the Greeks. Now, these aren't just some dusty academic terms. They are a live dashboard. They tell a professional exactly what kind of risk they're holding second by second.
First up is delta. This is the easy one. Think of delta as your speedometer. It just tells you how much your option's price will move for a $1 change in the stock. So a 0.30 delta call means for every dollar the stock pops, your option should gain about 30 cents. Simple enough, right?
But this is where the magic happens: gamma. If delta is your speed, gamma is your acceleration. A position with high gamma will see its delta ramp up like crazy as the market moves in your favor. This is the engine that drives that beautiful convex curve we were just talking about. But, of course, there's no free lunch. All this power has a cost. And that's where theta comes in. Theta is the slow, steady decay in your option's value just because time is passing. You can think of it as the rent you have to pay every single day to hold a position that has all that amazing potential to accelerate into profits. And finally, we've got Vega. And this one is fascinating. Vega measures how sensitive your option is to changes in expected future chaos, what the pros call implied volatility. With Vega, you can literally place a bet on whether you think the market is about to get more turbulent or more calm, and that's completely separate from which direction it goes. It is how you can trade fear itself. So once you get the Greeks, your whole perspective shifts. You stop seeing options as just individual lottery tickets. You start seeing them as, well, like Lego blocks. Like an engineer, you can combine them to build a payoff profile that perfectly matches your specific view of how the future might unfold. For example, you could build a vertical spread to make a directional bet for cheaper, but you just cap some of your crazy upside. Or you could use a straddle if you were absolutely convinced a huge move is coming, but you have no idea which way. Or hey, even a butterfly if your big idea is that the market is going to do absolutely nothing. Each structure sculpts risk in a totally different way. So what does all this really mean? It means you're not just a passive passenger on the ride anymore, just hoping the market goes your way. No, you're an active architect. You're literally designing the shape of your potential profits and losses.
Okay, now let's get into a really cool, truly professional technique that pulls all these ideas together. It's called gamma scalping, and it's basically the art of turning the market's natural chaos, its volatility, into a predictable stream of cash.
And how it works is it's beautiful, it's elegant. Because you own gamma, your position automatically gets more exposure when the market rallies and less when it falls. So to stay neutral, you are forced to systematically sell into that strength and buy into that weakness. You're literally selling high and buying low over and over again, just harvesting these little profits from the market's natural zigzag.
And this right here, this shows you why being on the right side of gamma is everything. If you're long gamma, volatility is your best friend. Every zig and every zag is an opportunity to make money. But if you are short gamma, you are forced to do the exact opposite. You have to buy high and sell low. Volatility becomes your mortal enemy, and it sets a trap that can lead to some absolutely catastrophic losses. All right, this brings us to our final and honestly the most important part of this whole thing. The ultimate skill of a professional options trader isn't just picking direction, it's asking the right questions before the trade to make sure the structure they build perfectly matches their view.
So what is that question?
Well, it's not just one question. It's a whole new framework for thinking that goes way beyond a simple, one-dimensional guess of up or down. And this table, this is it. This is the big aha moment. The amateur asks one simple question, up or down. But the professional asks a whole series of architectural questions. How violent is the journey going to be? What's my timeline? How much am I willing to pay in time decay while I wait for this to happen? And then, based on all of those answers, they ask, what is the single best structure to express that unique, multifaceted view?
Because here's the absolute key, the insight that separates the pros from everybody else. You can be 100% right about where the market is going, but if you choose the wrong option structure to express that view, you can still lose all of your money. A correct analysis in the wrong structure is a failing trade. Period. And that right there is the ultimate goal. We've come all the way back around from that casino ticket idea. The purpose of using options like a pro is to re-engineer your exposure to risk, to sculpt it until it perfectly reflects not just what you think will happen, but how it might happen and when. So, I'll leave you with this. The next time you have a strong view on something, whether it's in the markets or even just in life, ask yourself, are you just making a simple bet or are you truly designing your outcome?